Stop what you're doing. Seriously, if you own energy stocks or you're just hunting for some serious yield right now, you absolutely need to see this 5-model valuation breakdown. Last week, I ran Devon Energy through 5 intense valuation models and 2 legendary investing checklists. And honestly, what I found shocked me. $816 million. That is the staggering amount of free cash flow Devon generated in just the first quarter of 2026 alone. I mean, this stock's underlying cash engine is operating at a level that fundamentally shatters the old contrarian narrative that legacy energy is somehow dead. So that brings us to a pretty bold question. How exactly does a traditional legacy oil and gas company transform from a standard pump and sell operation into an ultra-efficient cash printing machine in 2026? Like, are they just getting lucky with oil prices here? Or is this a fundamentally transformed business that would make legendary investors like Peter Lynch and Warren Buffett back up the truck? Because let me tell you, they are wringing out capital efficiencies right now that most major tech companies would literally envy. Welcome to The Explainer. Today, we're running a comprehensive financial health check on Devon Energy, and I'm going to give you a clear, actionable framework that you can steal to evaluate this stock for yourself. Now, I fully acknowledge a massive fear that a lot of retail investors have right now, and that's stepping right into a dividend yield trap in the notoriously volatile energy sector. But by the end of this explainer, you're going to know exactly if Devon passes the ultimate Buffett and Lynch tests to stabilize those payouts, or if you need to just run away. Let's dive right in. Here's our agenda for today. 1. Q1 2026 earnings snapshot. 2. Driving down historical debt. 3. The free cash flow engine. 4. Navigating dividend volatility. And 5. The Coterra Energy merger. Section 1. Q1 2026 earnings snapshot. Notice the brilliant contrast here. On the left side, we've got production. Devon delivered 387,000 barrels of oil per day. That is a top-end beat, coming in 3,000 barrels over their midpoint guidance. But then, look over at capital spend on the right. They pulled off this massive production while only spending $848 million, which is actually 6% below their midpoint guidance. Producing more oil while spending less capital, that translates to a 60% reinvestment rate and just incredibly strict capital discipline. It's like doing more with less, but on a massive scale. Moving on to Section 2, driving down historical debt. Take a look at that peak back in 2015. Devon was carrying a massive, towering $12 billion in long-term debt. Fast forward to 2020, and they aggressively hacked that down to about $4.3 billion. Now, while it did creep back up a bit in the middle there, look at the significant drop by Q1 2026. They've pulled it back down to roughly $7.39 billion. That's an almost 12% decline year over year. And why does this matter? Well, every single dollar they aren't paying in interest expense on that old debt is a dollar immediately freed up for the core business. Which leads us right into Section 3, the free cash flow engine. You see, Devon isn't just extracting oil anymore. They are relentlessly extracting free cash flow. Based on their Q2 2026 outlook, and depending on where WTI oil prices sit between the $90 and $110 mark, Devon is projecting a free cash flow yield of 15 to 21%. That is just massive. To put it simply, in today's energy landscape, generating that kind of yield means your operational engine is perfectly, flawlessly tuned. So how are they doing it? Well, Devon set this goal to improve their pre-tax cash flow by $1 billion by the end of 2026, and they're actually hitting 100% completion of that goal way ahead of schedule. Their secret? They're utilizing AI models and agents right out there in the oil patch to flag unproductive time and share best practices across the board. This tech is allowing for 22% faster drilling and 19% faster completions compared to just 2024. Throw in an upcoming term loan repayment to lower costs even further, and they are literally squeezing $1 billion of optimization out of this business. It's wild. All right, let's talk about the elephant in the room in Section 4, navigating dividend volatility. Okay, so this historical dividend data from Market Chameleon might be a bit terrifying if you're an investor who relies on steady, stable income. Devon uses what's called a fixed plus variable dividend policy. And look, when times are great, payouts totally explode. Year-over-year dividend growth in 2021 and 2022 was up 233% and 269%. But yeah, it's a total double-edged sword. When commodity prices drop or costs shift even a little, that variable portion just vanishes. In 2023, the total dividend payout dropped 44.5%, and then in 2024, it plummeted almost 65%. So you definitely get the raw benefit of that huge free cash flow, but you also absorb all of that operational and market volatility directly into your yield. Which brings us to a massive catalyst in Section 5, the Coterra Energy merger. The absolute most crucial takeaway regarding this impending merger is the sheer scale of the capital return program attached to it. Management has gone on record stating they expect a new share repurchase authorization of more than $5 billion following the merger close. $5 billion. For you as a shareholder, that means the company is stepping in to aggressively buy back its own stock, meaning your remaining piece of the pie gets fundamentally larger. But here's the best part. They aren't just doing buybacks. They're directly addressing that terrifying dividend volatility we just looked at. Post-merger, Devon plans to increase the baseline quarterly fixed dividend to 31.5 cents per share. They're making a strong attempt to add a much sturdier, reliable floor to their payout structure, so investors don't have to solely rely on the wild, unpredictable swings of the variable dividend anymore. By joining forces, Devon and Coterra are creating a premier large-cap operator. Think about it, with the combined cash flow from these two massive giants, that new AI-driven optimization we talked about, and the incredibly strict capital discipline we saw back in Q1, they're essentially building an absolute fortress of a balance sheet moving forward. Which leaves us with this final provocative thought to ponder. Will the sheer scale of the Coterra merger and that new 31.5-cent baseline finally stabilize Devon's payouts enough to pass a Buffett or Lynch stress test? Or is extreme dividend volatility simply the permanent new normal if you want to hold energy producers in your portfolio? We are all eagerly waiting for the combined mid-June guidance to find out. Keep learning, stay focused, and I'll catch you on the next explainer.